We're here to talk about the Silicon Valley real estate market the week ending February the 6th, presented February the 7th, Saturday morning at 9 o'clock. These are the chapters that we're going to be going over, the key slideshows, so you can go to the section that you like the most. The timestamps are in the description below in YouTube. Here's an article that I subscribed to. It's down here at the bottom, housingnotes.com. And it's right on my point. There is no national housing market. There isn't even a Bay Area housing marketplace. There isn't even a Santa Clara housing marketplace. That's why the micro market is so important, in my opinion. It's the local micro market on where you're buying, selling, or investing in. And here's some key takeaways from that article that I found interesting. The handouts for the last 2 weeks that I didn't do are up there. You can get them by typing in the tiny URL, Silicon Valley Real Estate Market handout H, and then the year, date, and month. So it was up there for the 31st and the 24th. I wasn't able to do the presentation live because of technical issues, workload, and I also got a cold, as you can hear in my voice. Let me delete the slide and I'll be right back to the presentation. Okay, here's the first data slide. What we're looking at here is the turnover rate. That's how quickly you turn over the market one time if there's no new listings. So you can see that we're a little bit slower, but you're 105%. That's in the normal range. That's why it's white in this section. This is my range of normal. Up here, if it indexes up here, it's cool for the buyers. Down here is red hot for the sellers. Moving on to the next slide, we're looking at accepted offers. This is simply the raw count of the number of accepted offers compared to the previous 10 years, 2016 through 2025 for the same week. So you can see we shot up. I mean, 95%, almost 93%, call it 94%. That's the highest number we've had since the slowdown of 2022. So that is a pretty significant increase. Look how rapidly it's rebounding this year. Moving on to active inventory. Active inventory always comes up at this time of the year, and so does the normal number of offers typically. But you can see inventory is actually a little bit higher. Again, it's within that normal range at about 106% of normal. So you have 6% more listings than you normally do for this week. Here's the summary slide where you now look at turnover rate. And this is simply the raw time versus the past 13 weeks going back in time. The trend data goes forward for 13 weeks. The purple line is the current data. This week is in the middle of the graph. So you can see that and there is no vertical scale, but you have the raw numbers from 13 weeks ago, 42 days, 9% longer than normal. Now you're at 40 days and 5% longer than normal. And then you have the typical and the slowest and the quickest marketplace over there. So you're somewhere above where you normally are. So you're above the 37.6 days, you're below 47, and the actual numbers the 39. You can see that it's been coming down. It's been gaining ground on the gray line. The gray line is the 10-year median. That's the same week for the past 10 years. What is the median, which is the average of the middle two numbers? Now look at marketing time. That's gone from above the slowest you'd expect, which I define as the 90th percentile marketing time, all the way down to almost the least you'd expect, the 10 percentile. What's going on? Why are you having such a rapid change? It's the new listings that are coming on the market since the first of the year that are attracting the buyer's interest, and that's what's selling. It doesn't have time to accumulate the marketing time. So 3 out of 4 sellers right now are selling in 19 days. That's pretty good. You're not talking about the 50% of the marketplace that sells after that first weekend. You're talking about the 50% that doesn't sell after the first weekend. So they're already at 7 to 14 days, and they don't make it to the third weekend at 19 days. And pretty much they're only making it to 2 weekends because most agents, and that's what you're talking about in statistics, what the most people do, are listing like Wednesday, Thursday type time frame. They go through the first weekend, they go through the second weekend, and then they look at offers that third week. And that's what you are. You're short of the third Wednesday. So you're looking at it most likely after 2 full weekends of the market exposure. Price reductions. This number is very tight because very few sellers reduce their price. They do their homework before they put on the market. Then they put it on the market. And there's also a lot of price to excite, price to motivate, whatever you want to call it, where you list a little bit below, or sometimes the agents go way below, which I don't believe in. A little bit below makes sense. And so very few sellers are reducing their price. But you can see the average was 1.5%. Typical is only a half. So, at this time of the year, right now, you go anywhere from 0.1%. So between 1/10 and 0.2% price reductions to 0.5% is typical. And in a soft market, you're only doing 1 1/3% price reduction. And that's because it's rare to see more than 25%. In fact, it's rare to see more than about 20% of the sellers doing a price reduction. So you bring in a whole bunch of zeros. You can see right now, price reductions are a little bit more frequent than normal because it's below the gray line. It's towards the blue line, and the blue line would be favoring the buyers. Overbids. This is what the buyers are feeling when they're going out there. Right now, they're right then on the typical marketplace. In fact, they're a little bit under. They're overbidding 3.5%, and this is the average overbid. The median overbid is much closer to 100% or no overbid at all, and typical is 3.6%. That's in the noise levels. Real estate is very unique for each property that comes on the market. That's why you have to do micro markets versus zip codes. If anyone gives you data on zip codes, that's two fluctuations. It's really not telling, it's noise. But here, what you're looking at is essentially the buyers are feeling the market is as competitive as normally does. A quarter ago, they were overbidding 5.5%. Offers accepted. You can see we were right on the blue line for the last part of the end of the year. And remember, that's seasonally adjusted. Now, since the first of the year, you've come up and you're almost back to normal. You're at 93%. That's still in that normal range. I normally consider about 12%, 12.5% on each side of 100% to be in the normal range. That gives you an idea of how much the market flips. Inventory. Inventory's been essentially normal. Then we got down to a shortage of inventory last year, right at the end of the year. And again, it's seasonally adjusted. It's seasonally adjusted, but it's not adjusted for what day of the week Christmas and New Year's falls on. And that does make a difference. And that could explain why we dipped down. And then you can turn around and you came back up and you're right back up to the normal line. So when you see perturbations off of that for a short period of time, I believe it's more what day of the week did Christmas fall on. If I remember correctly, it was on Thursday. It basically extended the holidays one extra day, I think, is what it boiled down to. It was a Thursday, Friday holiday where it's in the middle of the week. Now, obviously, a lot of people take the whole week off and things like that. And then just the number of transactions. These are closed, successful transactions. We were down below the blue line. You can see that right at the end of the year. We're coming back up, but we're still only at 74% of the normal level of transactions that are closing. In a nutshell, since the pandemic, we saw that 18-month period of time when we had a surplus of transactions. And then we've had about 3 years where we've had a significant missing of transactions. About 20% of the transactions have been missing. Here's a summary of the micro market areas. You have the metrics going across the top. The highlighted yellow are the key metrics. They're the raw count for this year. The overbidding is orange because it's lagging. You need the sale price, which means escrows have to close. The dark green are comparing to the last 10 years. So it's a comparison, which is why everything's in a percentage. Offers and activity really by themselves don't tell you anything, which is why they're only on there. The raw count wouldn't matter because the size of each micro market is different, but the percentage of normal is. And you can see for all of Silicon Valley, you're at 80% as far as the number of offers. You're at 96% for the active inventory. Then you have the appreciation, and on the sold price, you have the median in the middle, the 10%, the cheapest you'd expect on the left-hand side, and the most expensive you'd expect. You got Silicon Valley, all three counties at the top, then Santa Clara County on the top section, San Mateo County and its micro markets in the middle, and then Alameda County and its micro markets. Here's some notes for those that want more information. Here is the first data slide, and here is my metric color scale. So when you're ice cold, you're this deep blue. When you're getting close to normal, you're pale blue. Then you go blue green, then green right when you're in that real normal range, yellow green as you go into a hot marketplace, and then a shade of pink as you get into a hot marketplace. This is the range for this particular metric. You have each of the major areas, Silicon Valley, and then 3 counties, and then each micro market, and then it's presented graphically. The gray areas are areas that I don't display the data for because, this is Santa Cruz County, San Francisco County, Contra Costa County sneaking out there. This surprised me. I think this is too rural because that's like the Sonoma area. I didn't know it had its own zip code, so I need to look into that. This one really surprises me, but I think that's because that's Hayward Hills, and the prices up there are so unique that it does, and it impacts the data, so I ignore it. And then this is Mount Hamilton zip code. Here's the next one, which is compare the turnover time compared to normal. So when you see the previous slide, you see a lot of red. So you have a hot marketplace. And I don't think anyone that's been out there working in the marketplace at all could deny that we don't have a hot marketplace right at the moment. Now, there are pockets of normal, and you have a little area up here in this very expensive areas in San Mateo County that are slower than normal or slow. But this is compared to normal. Here you have a balance. You have a few areas that are hotter than normal. You have several areas that are shades of green, and you have several areas that are blue. So you're hotter than normal in some areas, cooler than normal in others, and a lot of the areas are right on normal. Marketing time, hot marketplace, you're selling most of the stuff in 7 to 21 days. Remember, 3/4 of the transactions are under 19 days, I think it was.
You can come down to the slow area of South County and you're up at 60 days. So there are areas that are slow. Compared to normal, let's compare to typical. Here you have some green, you have some deep red, which is hotter than normal. You have some dark gray, which is cooler than normal. So you have the whole range. Here's price reductions. This is the actual raw count. So you can see that you got the whole range. And part of the reason you have the whole range is I tried to mimic the range to have it very tight. You can see up here, normal is only from going a 0.25% reduction to 1% reduction. Hot is where you're going from a 0.25% reduction to a 0.5% over. That means sellers are actually raising their price while they're before the offer comes in the door. And then it's only the cool marketplace that has any range at all. And it's only 4%. It just goes from a 1% reduction, a 5% reduction for a total of 4. So you can see your different areas. They're scattered out throughout. It's nice little artwork, actually. Here's compared to normal. Again, there's a large distribution of hotter than normal, cooler than normal, and most of it is normal to slightly cooler than normal if I was to read it, but there's a fair amount at normal. Here's reductions. So just simply how frequent are those reductions? The first one is the magnitude. So you can have few sellers taking large price reductions, or you can have a lot of sellers taking a little bit of reduction. So here it's saying that very few sellers are doing a price reduction. Look how red that is. So you're expecting less than 5 to 17% of the sellers are doing a price reduction to get any shade of red. Most of that is deep red. So look at some of these numbers: 3% of the sellers, 6% of the sellers, 5% of the sellers, 3%. You can see it's a very few number of sellers, and that's just, hats off to sellers that are doing their homework. But unfortunately, it also includes the ones that underprice the property. If you're 5% under market, I'm not going to debate that. But when you start going 10% under market, I think you actually lose some buyers that aren't willing to overbid to buy 10%. And to the buyers out there, bid what it's worth based on what else is selling. Don't bid it based on the seller's ask price. Here's the frequency of those price reductions. You can see that we'll have the full range. You got some areas where it's less frequent, and that's in Newark and Union City. Fremont is normal. A lot of San Mateo County is normal or hotter than normal, and that would be less price reductions than normal. This is overbidding. This is what the buyers are doing. And again, this is lagging data. So this is really where the market was probably 5 weeks ago, somewhere in that 4 to 6 week back marketplace. And that's because you don't know what the sale price is to calculate the overbid until the escrows are closed and the sale is recorded. But you can see that it's hot, and this is simply the magnitude of the buyer overbid. So from 1.5% to 17.5% is where you have a shade of pink to red. This is compared to normal. You can see, you got big sections over here of the sort of affordable areas in Santa Clara County that are blue. You have the Half Moon Bay, Redwood City areas that are blue. You have swaths of Santa Clara County that are pink. You also have a lot of areas in East Bay, San Mateo County that are green, and that would be normal. This is an exact, all these images are why you can't talk about a Bay Area real estate marketplace, which the media does so much. So appreciation is X%, volume is X, those kinds of things. It just doesn't work. Here's the frequency of overbidding. So how common is it? More common, fairly common in the middle part of Santa Clara County. The more affordables, it's a little bit less common. But again, it's all over the place. And this is also the time of the year where the metrics are changing very rapidly. You go back 3 weeks ago and the market was pretty calm. You come up now and the market's on fire. This is Super Bowl, so it's going to take people away. Next weekend is Valentine's Day and President's Day. So the next normal weekend we're going to have isn't until the 20th of February. Here's the frequency of overbidding. Again, it's all over the place. You can see in a nutshell, the east side of the Silicon Valley is sort of a little bit cooler than normal. The west side is sort of right at normal to slightly hotter than normal. This is the appreciation. This has been moving significantly since the pandemic. Right after the pandemic, sort of the far remote areas like Livermore were the hottest areas of appreciation. Central Valley was doing really well. Now it's sort of close in. People are having to go to work a little bit more often. The areas that are appreciating in high demand right now are a little bit closer. And this is going back to 2015. So it's long-term appreciation. But because of compounding, the areas that are appreciating most recently are the ones that are typically going to have the highest appreciation rate. Here's sold price. And instead of following just the median number, which is the middle number, I do sandwich it with the cheapest 10 percentile in a given area and the 90% the most expensive you'd expect. Now, obviously, if you're holding out for an expensive home in Milpitas, you can get it. But right off the bat, only 1 in 10 homes is going to be over $1.75 million. Likewise, on the downhill side, if you're trying to get a home in Milpitas for $1 million, that's going to be way less than 1 in 10, because on 1 in 10 is only less than $1.25 million. Here's the number of offers accepted compared to normal, because there's no reason to look at the raw count. You can see you're on both sides, the yellow green, the blue green. You got blue. I don't see any real red. So the number of offers compared to normal is down across the board, is what I would say. And again, I apologize for my voice quality. I do have a cold. Here's the number of active listings across the board. You're sort of normal to a little bit. Blue would be favoring the buyer, which would be more inventory. Pink over here and the west side of the valley would be favoring the seller. And here's the summary chart that we started with. I won't go over the details again. Here's some more details. We'll go into the next chapters. Here now what we're doing is we're looking at Silicon Valley in the blender, exactly the thing I said you can't do and get meaningful data. You look at Silicon Valley as a whole, and then you look at your micro market data to see what's going on. You can see that we were just 2 weeks ago up here, and we were quite a bit above the normal level. We've come down, and I would say we're right at normal level of turnover time right now. You can see how steeply it changes at this time of the year, and these are the 10-year medians. So this is how dramatically the market changes every year to impact the 10-year median. Here's the turnover time on a percentage basis. You can see back in 2025, we were really slow during second quarter. And then you came up to this roughly 110%. We've been doing this huge oscillation. And I think that's more a calendar event with where Christmas fell back here and New Year's, the holidays. And now you're coming back and coming to real normal. This weekend and next weekend, in my opinion, won't be normal weekends. Yes, there is always a Super Bowl, but when it's in the local community, it draws more attention, and real estate's an optional event. And anytime there's something going on, real estate market takes a hit. Turnover time is all over the place at the moment. Here's marketing time. So this is how quickly, and this is a shift that happened this year, and it happened in 2025. All the other times when you go back and look at this, and we have the data for the 10 years that I take the median for, you can see that the purple will be at different levels, but it lines up with the 10-year median. Here in 2025 was the first time I remember seeing this horizontal, this time shift, and you shifted from the middle of first quarter all the way back to sometime at the very last week or two of the previous year. This year, we've had the same shift, but not as much. I would say the shift happened either the first or second week, and I'd call that the first week in 2023. Normally, it doesn't happen until about one more week down the road from now. But you can see the trend is the same. It's happening earlier. And I think the only way you can explain this is buyers are waking up to this real estate cycle after that's been so pronounced for so many years, and they're accentuating it, and they're going out during the holidays and pulling the speed up further back in time. That's the only explanation that I have for it. It's pretty clear. Because it's a moving 10-year median, eventually, if these accelerated periods happen, these 10-year medians will move up, but it's going to take a couple more years, because now you have 2 accelerated years out of 10. That doesn't impact your median. You have to start getting to 5 and 6 before it really starts impacting the median. Here's compared to normal. Look how dramatically that accelerated. You're now down to somewhere around 45%. So that's much faster than it normally is. It's not as fast as it was in 2025 real early, but then 2025 petered out. And it was also faster in 2022, and 2022 petered out. So just because the market's fast right now doesn't mean it's going to retain fast. And when you're looking at compared to normal and seasonally adjusted, you don't know what direction that data is going to go next week. It could be back up here next week. If you're looking at raw count, you can almost guarantee it's going to be at the same level or a little faster. Here's the seller's price reductions, and this is looking at the 97.5 percentile. This is a very odd metric. It's one I actually like. It's looking at the sellers that are taking the largest price reductions, and what are they doing? And that's because you have magnitudes. And you can see that just at the end of last year, they were taking a 16% price reduction. And when you're talking about a $2 million home, a 16% reduction is huge. They're now down and taking an 11% price reduction. And again, that's more than they normally do. There's not very many of these sellers, but they are out there. But there were sellers that overpriced, because if the house was priced right, the buyers would have bought it. So it's not that you go hunting these. It gives you an idea of what the market's doing. This now is looking at the average price reduction. And this is what a lot more people would follow. It's a more normal metric. You can see that we've been going from halfway between the least most price reductions you'd expect to the typical, you're catching up to the typical price reductions. So we're still taking slightly more price reductions than normal. What are we talking about? You're talking about 0.7%. Normal would probably be 0.5%. I'm not sure that's significantly different. It's such a small number and it's such a few number of sellers. The trend of pricing is up, even if price reductions are more than they typically are. Here's percentage of normal, and that would tend to agree with me. And that's why I present the raw data followed by the comparing to the 10-year normal, is that I wouldn't have thought from that slide. I called it normal, but I was hesitant. Here, you're actually well within that normal range of 12.5% of 100. So here's the frequency of price reductions. So frequency, it's right on normal. So since you have normal number of sellers doing a price reduction and the amount of the price reduction is larger than normal, that says that the sellers that are doing the price reductions are doing larger than normal price reductions. And a couple of weeks ago, I was talking about how Alameda County was having the longest marketing time, but the highest overbidding. I think what was going on, and I don't have the data to back that up, is sellers were misreading the marketplace, coming on overpriced, not selling. Then they misread the marketplace again, reduced their price below where the market was. And even though they've been on the market for 5 weeks and just took a price reduction, they got overbid. So that's how you can have things like that happen. But here the frequency is right on normal and the magnitude is greater than normal, which means it's statistically the sellers that are reducing their price are taking bigger price reductions. Here's compared to normal. So you can see now we're going over into the hotter marketplace where we're taking a little bit less frequent, apparently. But you're still within that normal range. And you can see that you spent time right up here where it was almost cool. You spent time oscillating back and forth here. I defined it as 12.5% just because I haven't had the time and the energy to go through and determine what's normal for each metric. And it should be based on the data for the past 10 years, in my opinion, versus just arbitrary 12.5%. But if you look at this, you can see you spend a roughly equal number of times above and below. And so it's a reasonable representation. Here's overbidding. You can see that this is the median. This is the one time I talk about the median overbid. You can see we were right at 100%. And this is why you can't really use 100%. You have times like this or times where you were locked in at 100 and having no change, but the data market was still changing. That's why I use average. I'm normally not a fan of average, but if you're going to be at 100% a fair amount of time, and you can see the blue lines there more, it doesn't make sense. But this is the one time I put on median. So half the sellers are getting overbid, half the sellers aren't. The midpoint of your sellers on overbid, underbid, and this is really the buyer's overbid, underbid, it's 100.5%. So more buyers are overbidding than are underbidding. And here's the thing on a percentage basis. You can see it's a little bit less than a normal, but very close to that 100% line. Here's the frequency of overbidding. So again, how common is overbidding? I would call it right on the gray line right now. You can see you were having less overbidding just a couple of weeks ago. Where the market is right now today, if I had to guess, it's probably slightly above the gray line, but there's no way to know. You don't know what those sale prices are. So again, anytime you're talking about needing sale price for appreciation, 10 and 90 and median sold price, or overbidding, that's a lagging indicator more so than normal because of the length of escrow. All my data is lagging by a little bit because in order to get the data to be significant in size, to not have noise, I do use a 5-week moving month, and that lags the data a little bit right there. Here's the frequency of overbidding. You can see that right now you're a little bit below normal on a percentage basis. I think that's about 98%. Here is my pricing model, and you can see why I say prices have been flat for the last 4 years. Yes, prices did definitely go down lower at the end of 2023, the second half of 2022, and the first quarter of 2023. But other than that, they've been basically flat. Look at where you are right now. That's pretty low. It's going to come back up. It's going to look at the V every single year. Prices are low right now. It's a combination of not as many buyers are out there looking. It's a combination of the homes that are actually selling. The market mix shifts a little bit to less expensive homes, smaller homes, homes that don't take the holidays so seriously, and those kinds of things. They're all single family homes, but you have large homes in expensive areas that sell at some times of the year, smaller homes and homes in less expensive areas sell at other times. Some of this downturn at the end of the year is market mix and not appreciation or property values. Now, this is offers accepted. You can see that we've been having a shortage for the last several years. You can see coming all the way back to the pandemic. Here's where you had the surplus after the pandemic. Then you went into 2022. And if you look at it, we were right there. That's beginning of second quarter. There are some data sets that I believe the market really shifted on Valentine's Day, but you can then lost your offers accepted and came down, and it was already gone by the end of second quarter. So it was short lived, and then it was a typical end of the year cycle. But you've never recovered, and I think there's a lot of things holding us in. People now have 3% interest rates. People have huge capital gains tax, even with the $250,000 exclusion, and that's keeping people in their current homes. Active inventory, you can see active inventory is basically back to the normal level. You can see it's been normal for the second half of 2025. Here's again some extra definitions for what we're going into next. Here's the turnover time. This is how quickly you sell the market one time. If there was no new inventory coming on the marketplace, rate of sale stayed the same. How long would it take to sell? You can see Santa Clara County in the blue is 34 days. San Mateo County in the orange is 39 days. And Alameda County is the longest at about 46 days. So here, instead of looking at Silicon Valley as a whole, we're now coming back and starting to look at little finer, and we're looking at each of the three counties to see if there's a marked difference on how they're performing. Same thing on time to sell. This is the 3 out of 4 sellers. How long are they taking to sell? San Mateo County is the fastest at 14 days. Santa Clara County is next at 16, and Alameda County is the longest at 32 days. That's twice the time it's taking to sell in Santa Clara County, which is why the Silicon Valley metric is 19. But if you're looking in Santa Clara County, it's not 19 days. It's down here at 16 days. And if you're looking in San Mateo County, it's 14. And then from each micro market, it can get even lower than or higher than that. Here's the average price reduction from the different sellers. San Clara County is taking the least at just over 0.5%, followed very closely by San Mateo County at 0.6%, and Alameda County is taking 1%. So when you're talking about the largest price reduction being 1%, it's in the noise level. And if you go back and look at it, it's typically in the noise level. And that's why, to me, the average reduction really doesn't help, which is one of the reasons I like the 97.5 percentile. It has wider market changes. You need a metric that's reflective of the marketplace and also moves enough that you can see changes in that metric. Here's the frequency of price reductions. You can see San Mateo County is only 6% of the sellers are doing price reductions. Santa Clara County, 9%. And in Alameda County, with the most price reductions at 14. So way less than 1 in 5 sellers are doing a price reduction. And you can see how rapidly that's dropping off. And again, I'm going back 5 weeks in time. So a seller coming on the market now isn't going to have an opportunity to reduce their price. And that's why the number's dropping down so quickly. Here's the average overbid. You can see they're very clustered together. You could call it almost a three-way tie. You're probably at 3.25% to 3.75% overbid. So very tightly close. You can see Alameda County has the highest overbid. And if you remember, it had the longest marketing time. So it's not as pronounced as it was back here. But again, it's sort of, you wouldn't think you'd have the highest overbidding in a county with the longest marketing time. Here's the frequency of overbidding. It's how common is overbidding. You can see all 3 counties are over 50%. Santa Clara County has the highest at 58%, call it, for all practical purposes. Again, right now it appears to be increasing pretty rapidly. Here's the long-term appreciation. Santa Clara County has the highest appreciation at 180%. Of course, that's 80% appreciation since the last 9 months of 2015, followed closely by San Mateo County at probably, 74% appreciation maybe. And the least appreciation is Alameda County at about 52.5% appreciation. Here's the price on log scale. Alameda County is obviously the most affordable. Look at the long-term trend. San Mateo County was almost always historically higher than Santa Clara County, but basically since the pandemic, there's been times when it's reversed and the blue is on top of the orange. They tend to be short-lived, but right now you're getting back more to the traditional historical San Mateo County being more expensive than Santa Clara. Here it is on same information on regular paper for those that prefer. So San Mateo County is at 2 million, Santa Clara County is at 1.75, and Alameda County is about 1.15. Here's the PITI using the national rate. You can do better than this by going jumbo loan mostly. Although right now, some lenders are actually charging higher rate for jumbo loans, which used to be the trend all the time. Then it became rare, and it's coming back where jumbo loans are a little bit more expensive. But to be consistent, I'm using high balance conforming rate for the nation It's an easy for me index for me to find, but almost every bank has a stock brokerage relationship, which they do relationship pricing, so you can get lower interest rates. And of course, there's always adjustables. Here's the offers accepted. You can see all three counties are turning around. Santa Clara County has the highest. You can see that Santa Clara and Alameda County, the blue and the gray, are always very close together. San Mateo County is always lower because there's fewer housing units in San Mateo County, not because it's a slower marketplace. Here's active inventory. Same concept. Long-term, Alameda and Santa Clara County has been very similar. Basically, since the pandemic, Santa Clara County has been mostly below Alameda County. Here's some raw numbers. I threw this up for a few weeks ago when we were down here, basically very close to the lowest out of the last 25 years. We've really come up in just the last couple of weeks. We're now at 22% of the lowest. We're the third low least in the last 10 years and the third least out of the last 25 years. Here you can see you were the 24th. So you were the second worst year out of the last 25, which is why these are shaded gray. Now, yeah, you were even close to the worst. 1226 and only selling 1241, 1061 versus the worst of 1031. So we were right down there, and that's why these percentages are of interest. And here's actually the raw count for the data we've been going over. You have Silicon Valley overall, Santa Clara County, San Mateo, and Alameda County with the different metrics. Here's your appreciation since 2015. And if you want to look at your appreciation since the pandemic, it's here broken out. You can see that Santa Clara has done the best since the pandemic, but San Mateo County has come up and now it's almost even. Alameda County has lagged behind, and that sort of surprises me because initially there was the big push for longer commutes and Alameda County was absolutely on fire. And then if you look at since 15, that's up here, the order is the same. So and it didn't used to be. So now the order is the same, 82% appreciation for Santa Clara, 74 for San Mateo County, and 52 for Alameda County. Long term, you don't expect that differential to be that significant for areas so close, because if Alameda County continues to have lower appreciation, the dollar amount gets to be bigger as the prices go up and people will start moving into Alameda County. Here's some customization I do for buyers that want to work with me. I add in direct links to the detailed MLS, which is really easy, but I add in things like map links, schools, rating scores, school names, whatever you want, and commute times from Google Maps for different workplaces. We have been talking about the Silicon Valley real estate market. We have to get into distributions if I have time. We finish up with the Greater Bay Area, 5 regions and 13 counties. If you want to look at the handout, it's the green root URL, the letter H for handout 2026, 02 for February, 07 for February 7th, or you can type in the longer blue URL and get there. Join live presentation Saturday morning, the green root URL 2026, or the longer Zoom link and YouTube links. I'm Richard Calhoun, real estate broker with Creekside Realty, working buyers or sellers here in Silicon Valley. Here's some more key metrics on the distribution. Here, what we're doing is we're looking at the marketing time. I have every transaction from 50% up to 90%, which it's only 40% of the marketplace. But down here, it's not going to tell you anything. Look how close together all these different lines, even your best line down here, the red, and your worst line are close together when you get to the 50 percentile. Right at this time of the year, the purple is the current data, you're getting very steep. You can see that last year we were also very steep. As soon as the top end starts becoming less steep, the market's already slowing down. Let's step through. We do 1 week at a time initially. Look how far that jump is. We started off a year ago. There's it's leveling off. Now you can see you're really slowing down. You're increasing slightly. So the peak of the marketplace as far as marketing time is very short-lived, as are a lot of the things. And you can see you're just taking longer and longer to live. And you're only in June. So the concept that the time to sell is in the summer in Silicon Valley is wrong. There's the sort of the peak right there in September. Look at that improvement. That happens some years, and now we're at like Halloween. Now you're going to cool down for the rest of the year. So it's a fairly fast pace, but you can tell which way it's going to go. And there's sort of the coolest marketplace, like January 10th it was. And now you're accelerating. And see how this line is getting steeper on the right-hand side? That's telling you that you're improving. Not only is it the decrease, and that's just because you're working through the overpriced. It takes longer for the real overpriced and the ones with longer marketing time to sell, but they will sell as the market improves. Moving on and doing roughly the same thing with the largest price reductions. I go from the 97.5 percentile down to the 82.5 percentile. It's 15% segment of the marketplace, downshifted by 2.5%. We're
Coolest marketplace we ever had, the largest price reductions was this blue dotted line down here. The least amount of price reductions we had was February 14th, 2022, was the red dotted line up here. The purple line is this current week's data. The dotted line is where we were a year ago. We'll step forward going 1 week into the future, but a year ago. There it is. That's basically the peak of the marketplace for several weeks. It looks like 3 weeks in a row. Then you're starting to cool off, really starting to cool off. And then remember, this is only April and we're really cooling off. That shows you how out of sync most of the consumers are and even agents are on the marketplace. That's about the bottom of the marketplace. Now it's actually accelerating ever so slightly right at the end of August. There's another acceleration. Now it's cooling back down for the end of the year. Just little fluctuations back and forth, weekly perturbations. Now it's improving, and as you get into the new year, January 17th is a marked improvement, and the purple line is February 7th, and you can see that we are more price reductions than we were a year ago, but fairly close. The year ago, we were on the dotted line. The purple line is where we are today. And the third and final distribution is price overbidding by buyers, going anywhere from 5% of the marketplace up to 95%. So this now I'm covering 90% of the marketplace, dropping off 5% on each side because it's so irrelevant for most of the consumers out there. You can see that 10% of the buyers are paying exactly ask price, 35% are below ask price, and roughly 55% are above ask price. You can see a full 5% of the buyers are paying 25% above what the seller's asking for their property. Same concept. Blue is the least amount of overbidding. Red is the most overbidding we've ever had. And again, this is going to be lagging behind by about 5 weeks. Remember, on the previous slide, price reductions, the peak was Valentine's Day of 2022. This now is March 29th of 2022, a full 6 weeks after the market already appeared to have shifted. So it took a while for the escrows to close, and it took a while for the buyers to realize the market changed. So you're starting off on the dotted line a year ago. The purple line is the current data, but we're starting a year ago and stepping a week at a time. You can see the market's rapidly accelerating, improving. There's the peak in the marketplace right around March the 8th. It stays up there for a couple of weeks through basically the month of March. Then it starts cooling down in April. That's lagging, remember, lagging data. So it's actually the month of February that's the peak of the month. Dropping down, sort of at the bottom of the marketplace there, did a little acceleration in September, which is really in the month of August. You can see it marching up. That's probably the peak on it for November the 8th, and now it's cooling down for the end of the year. Right at the bottom, several weeks in a row, a little bit lower there. There's the bottom on January 31st, and now 1 week later, February 7th, we have already improved, and I would expect this to continue to jump up in significantly like it did last year. Here's some definitions for the Greater Bay Area. So now we're leaving Silicon Valley completely. The Greater Bay Area is 5 regions right over here, 13 counties all listed, and some more definitions for those that would like more detail. Here you can see that all of them are coming down. So turnover time is dropping in all 5 regions. Turnover time, the lower the turnover rate, the more it favors the seller. Silicon Valley has the lowest, followed by the cities, followed by Central Valley, followed by North Bay, and the Central Coast has the highest at about 82 days to sell their inventory one time. Here's the typical seller, 3 out of 4 sellers. Silicon Valley is absolutely the fastest at about 19 days. Next is the cities at 50. If I'm doing my math right, that's basically almost a 3-to-1 ratio. Not quite, but darn close to it. Then you have Central Valley in third place at 70 days. And then you have a 2-way tie for last at Central Valley and North Bay at somewhere around 85 days. That's for the typical seller to sell, about 75 days. Here's price reductions. Silicon Valley is the least. If you're not picking up the pattern here, Silicon Valley overall is the hottest out of the Northern Bay Area. You know, our marketplace is unlike anything else. You know, people talk about the Bay Area real estate market being aggressive. It's really localized in Silicon Valley because even San Francisco Marin, North Bay, Central Valley, completely slower, less aggressive marketplaces. Price reductions, Silicon Valley, you're up here at something like 0.7%. Next is the cities at 1.4%. Then you have the Central Valley at about 1.8%, North Bay at about 1.2 percentage points, and the Central Valley at 2
0.4% of seller reduction. This is the average. That's why the number's so small. The sellers that are actually doing price reductions are taking larger than 2% price reductions. Frequency of price reductions, Silicon Valley, only 1 out of 10 sellers is reducing their price. Cities is in second place, 17% of the sellers reducing their price. Central Coast is in third place at 30%, North Bay at 31%, and at 33% would be the Central Valley. Overbidding. Most overbidding is in the cities. That's the one metric that Silicon Valley is not in first place. Silicon Valley is second place at about 3.5% overbidding. Every other region, the three remaining regions, North Bay, Central Valley, and Central Coast, the buyers are coming in below the seller's ask price on average. So there's only 2 out of the 5 regions where overbidding is that common, that the average is an overbid. Frequency of overbidding, Silicon Valley is overbidding higher than the cities. So that means the cities that are properties that are getting overbid significantly more than Silicon Valley is, because they have roughly the same frequency, but the cities really outperform Silicon Valley as far as the average amount of overbidding. North Bay and Central Valley are right about 30%, and Central Coast is about 24%. Less than 1 out of 4 sellers are getting overbid. So you go from 1 and 2 to 1 and 4. Here's the appreciation. You can really see the cities has fallen off and only had 40% appreciation since the last 9 months of 2015. Then the North Bay at about 55%. Then you have the Central Coast at about, I would call it 67%. Then Silicon Valley at about 73%. And the highest appreciation is in Central Valley at about 86% appreciation. And that doesn't necessarily mean property value, because in the Central Valley, you have areas like Mountain House that has a lot of activity going on now as the new homes are hitting the resale marketplace that is a higher price than the typical home in San Joaquin and Sacramento area, pulling up the median. Here's the sold price. Silicon Valley is second place. The cities is the highest marketplace at 1.6 million. Silicon Valley is at 1.5 million, pulled down by Alameda County. Central Coast at just over 1 million. North Bay at just under 750, and the Central Valley at just about 525. Here's estimated payments using the high balance jumbo loan for the national average. You can get a better interest rate, so lower payments, but you can see they're in the same order as the monthly as the sale price. Here's offers accepted. You got a 3-way tie. You don't see this very often, but you have Central Valley on the top, and I would probably call it the Silicon Valley, but it's really hard to tell. And I think that's North Bay right underneath. It's definitely North Bay, but I think North Bay is a little bit lower than Silicon Valley. But a 3-way tie for first place on the number of offers accepted. You can see they're running close together, but to have them all basically at the same level is unusual. Usually Silicon Valley is on top, as you can see looking back over time. So for Central Valley to be outperforming Silicon Valley as far as number of offers accepted is interesting. Thank you. That's the end of the presentation. We have been talking about the Silicon Valley real estate marketplace, followed up at the very end with the Greater Bay Area, 13 counties and 5 regions. Here's the YouTube links and everything. I'm Richard Calhoun, real estate broker with Creekside Realty, representing buyers or sellers here in Silicon Valley in single agency transactions. The handouts are available. Even when I didn't go live for the last 2 weeks, you could have pulled down the PowerPoint presentation. Those were both loaded. The green root URL, the letter H for handout 2026, 02 for the month of February, 07 for today's date, February the 7th. Or you can type in the longer blue URL, which is for this week. You can join Saturday morning at 9 a.m., the green root URL plus the year 2026, or the longer blue URL if you don't want secondary links. And finally, the archive on YouTube or the short green URL link gets you there as well. Thanks for joining. Take care. Bye for now.